Hey, welcome to Mortgage Minute for June 23rd. Well, I took a couple of weeks off for the Stanley Cup playoffs. We won't talk about that. I'm from Vancouver. Anyways, there's so much going on in the news these days about debt and interest rates. And I mean, a lot of the same old, same old. Wrote an article yesterday called The Deja Vu All Over Again. Here it is. The big thing that Mark Carney came out, the rest of us were watching Game 7 of the Stanley Cup Finals. Mark Carney's in Vancouver saying, better brace for a shock. This is pretty strong headlines, telling us to brace for a shock. Bottom line, Carney's saying he's concerned about the amount of debt that Canadians are carrying, and in particular, house prices in Vancouver rank the highest. Some suggesting that we're 21% overvalued in Vancouver. What's going to happen if they raise rates? How are we going to be able to afford things? So the headlines continue. Carney warns on housing markets. Bank of Canada chief says that there is risk of fear and greed that are driving the real estate market. Well, we also know, especially in the Vancouver market, a lot of that's been driven by foreign investment from China. But while we're worrying about real estate prices, the other shift of concern is that the low rates are helping to push households further into debt. So there's this big concern that Canadians are taking on too much debt. 2 days later, what do they say? Family debt still growing. Average Canadians have a record of $45,000 in credit. Even the Wealthy Barber is getting into the act here. The famous author of The Wealthy Barber now coming out with version number 2, suggesting that the government abolish all forms of lines of credit is the burden and curse of society in Canada. Well, the big thing is saying, well, if we got all this concern about debt, why doesn't the Bank of Canada just raise rates? They can raise rates and slow down this borrowing trend. Well, here's the problem. In the United States, they're still struggling with their recovery. So the feds are concerned about the slowdown of the economic growth in the United States. This translates into Ben Bernanke, who's going to stop quantitative easing. By the way, quantitative easing means he's going to stop printing money as of June 30th. But at the same time, he still has made it clear that they need to still have some form of stimulus. So the United States is not going to not going to raise rates. U.S. rates are going to stay where they are. So again, Mark Carney is screaming at Canadians to stop borrowing at these low rates, but can't raise rates if the United States are not. Compounding all this is Greece. Oh my goodness. Here we are, a bunch of idiots rioting in the streets of Vancouver over the loss of a hockey game, while Greece has 80,000 people turning out for a protest/riot in Athens because their government has literally days to decide on austerity measures, or the European Union is going to pull the plug. Now, all this results in global risks threaten the Canadian recovery. So if you add all this up, you end up with the U.S. recovery is not there. Canada cannot separate themselves from the United States by raising rates while they're not. The potential disaster in Greece has a ripple effect implications, which we'll talk about at a future date. Could be the second stage of the subprime crisis, depending on how they handle that there. All this is translating into Mark Carney having his hands tied, saying, geez, I want to raise rates, but I really can't. So for you guys as homeowners, you're going to see yet another period of prolonged low interest rate environment in Canada. Again, I can't say this enough. That is temporary, although we've been saying that for 2 years. But, take advantage of it. In the meantime, the bond yields have lowered, and the 5-year rate has gone from 4% down to 3.69%. We're seeing 5-year long-term rates at the lowest they've been in years. Take advantage of them over the summer months, because I can guarantee you that's not going to last. For more information and a copy of the article that I wrote on this, go to peterkinch.com. That's the Mortgage Minute. We'll catch up with you soon. Thanks.